Professor Weiss, thank you so much for joining us on Chicago Capital. It's a true honor to have you here.
Thank you for having me, Matt. I've been listening to your podcast for a while now and excited to be part of them.
Thanks so much. That means a ton. You are our first academic on the podcast. So I guess, it's fair to say class is officially in session now. I've been waiting to make that joke for about a month. So I'm hoping some people appreciate it.
That's great. I don't know if that's a plus for the VC community, but I'll take it anyway. So thanks, Matt.
So mention that you're an academic. I think we'd love to hear about your background a little bit. It's fascinating, and you truly have sort of a unique perspective on VC, given how much time I think you've spent in the academic world. And I know there's at some point a shoe salesman role that played a great effect in your development. So we need to hear, I think, the whole tapestry of the history of Professor Weiss.
Okay, well, I'll start with that, which is like I'm literally from a family of shoe salesmen and shoe salespeople where like my great grandfather back in a country called Galicia in Europe owned a shoe store. My grandfather, they moved to Chicago and he ended up with two shoe stores. My father owned a small chain of shoe stores in Chicago called Tico Feminine Footwear. I have two brothers. My brothers and I all worked at a chain of shoe stores in Chicago called Churn and Shoes to make money on the side while we were in high school. So like it just goes back forever. And I think the way it relates to the work that I do in the venture world is like my father was an entrepreneur. I mean, he was a real entrepreneur. He started a chain of shoe stores from nothing, built it from one shoe store up to 7 shoe stores. And he was kind of hurt a lot by the recessions at the time, which hurts retail. And so he ended up back down at one shoe store after he ended up at 7. And so, part of what I feel like when I'm helping a bit, VCs don't really do the work, but like helping a bit with entrepreneurs is like I'm kind of like helping my father's passed away, but like helping the memory of my father to be as successful as possible. So that's kind of the history, at least on the shoe salesperson side. Went to college, worked as an accountant briefly, for a variety of reasons, decided to get a PhD in accounting. I'm pretty sure I'm the only accounting academic who's a professor who's, now does venture capital and investing work. But I got my PhD at Chicago. Matt's great that you're an MBA student at our school. And then I went to work at Columbia Business School in New York in 1999 when the tech bubble was in its bloom. And frankly, a lot of my MBA students were going off, like literally ditching their second year of business school to go off and work at tech companies. And so there was a professor there named Matt Rhodescroft, who was a finance professor, and I was an accounting professor. And the two of us started doing startup investing on the side of our day jobs. And we like to joke that we'd like work, and then we'd like take all of our, whatever hard-earned money that we had, and we had a very expensive hobby called startup investing. And we did that on the side for a while. And then, eventually we formed a group that's akin to a pledge fund. And we got some, friends and family involved in doing some of the startup investing with us. And that's kind of the beginning of my venture career. And what I realized was I did really like the academic world and really like the teaching part of it mostly. Loved working with students, MBA students and others. But I really just fell in love with working with entrepreneurs, the excitement and the energy of people who have new ideas, people pitching to me all day on, what is the world going to look like in 3 to 5 years, learning about new industries. And so, I just have been very, very fortunate that I've been able to do both over time. Spend some of my time teaching MBA students like you, Matt, and some of my time working with entrepreneurs and investing in startups. So that's right. So I was in New York for a bunch of years. I moved back to Chicago to teach at the University of Chicago. There was an angel group called Hyde Park Angels that had started right after Grubhub and Braintree went through the new Venture Challenge business competition at the University of Chicago. And so for a variety of reasons, there was some alumni that got together to form an angel group. The school was open to that, an angel group that was affiliated with the school. And so I was asked to step in to help run the group and really be like a liaison to the group in the early years, helped with the group for the first few years, and then branched off and started doing investing on my own and formed Hyde Park Venture Partners with Guy Turner, who I know you've already had on the podcast.
Well,
Big shoes to fill. Big shoes to fill since I know you've already had Guy.
yeah, it's the follow-up act. It's the encore everyone was clamoring for after we had Guy on. People were just saying, you got to get Professor Weiss. And I can attest to all listeners, the VC Lab course, which Professor Weiss teaches, is worth the price of admission to Booth on its own. So I can't recommend it enough. I can't recommend Booth enough if you're interested in the space. Had to give Booth the quick plug there.
I'm
But
flattered. I think it's probably because you like listening to Jason Heltzer, who I know you've also had on the podcast.
no,
So, but I'll consider myself the player, the also ran. So.
No, it truly is an excellent course, and it is. I don't know how many other business schools out there you can get to practicing, managing partners at two of the most preeminent funds in that given geography to sort of come in every single week and teach you all the tricks of the trade. One thing I'm curious about, just based on your background, based on how much of a focus you've had on accounting for your entire career. When you started making angel investments, did you ever think maybe you wanted to move later stage where there was a little bit more data to support these investments that you were making? There's a little bit more accounting being done because you are very focused at the early stage. And it's just a funny sort of, to me, it's a funny pairing, an accounting PhD and early stage startups. How did that sort of, how did that develop over time for you?
Yeah, I think it's a very insightful question about me, Matt, because and even when I started doing startup investing, there was a little bit of a disconnect where like, accounting professor, academic, there's a lot of rigor that's typically involved in a lot of the stuff that I do. And then you have early stage investing where like, in many cases we're investing at, pre-launch stages. And so, I think, I don't know. I really love early stage investing. I think now I've been fortunate because some of the companies I'm involved in have gotten to be much later stage. And so I'm experiencing more of the later stages, and that's a pretty interesting stage as well. But I think there's nothing really like being involved really towards the beginning or at the beginning. We don't, VCs don't do the work. We don't do any of the real work. But like even like an intro here or like introducing someone to, someone who becomes an early key employee and the impact that can have on people's lives, it just feels like when the companies are much larger, it's just harder to have as big of an impact. And so I think I've definitely enjoyed the impact and really getting involved pretty early.
And we'll talk about, you mentioned some of your companies moving on to later stages. Oh boy, is that true. We've got a few companies that hopefully we'll get to that have reached unicorn status from Hyde Park's portfolio very recently. But a few more questions on, your background, I guess, is have you found over time, what has it been like balancing, being both a professor and a venture capital investor? Have the roles over time sort of informed the other? Have you taken some of your time you spend in the classroom around young sort of students who are looking to found companies, and will you ever make investments, from those relationships, or how have the two sort of merged over time?
Yeah, I mean it's a great question. I think the way that there's been overlap, to be honest with you, is mostly through the investing that I've done with startups and actually bringing that into the classroom a bit. And so, I've been co-teaching the Venture Capital Lab class, but I also teach a class called Accounting for Entrepreneurs. The sexy part of the topic is accounting for entrepreneurs from startup to IPO. And I think, by making these startup investments and being involved in a lot of these companies, I think it does give me not just anecdotes, but a lot of context for the kinds of things that it's helpful for students to know as they're going off to start companies or they're going off to be part of entrepreneurial teams. And so I think it's mostly been that way. I mean, I think here and there, every once in a while, there's certainly great teams that are coming out of the University of Chicago. To be honest with you, just to try to help avoid conflicts, I have other folks at our firm work with if they're still students, kind of work with directly with those students. But I think I also in some ways like now have had the context over time of watching these companies grow and thinking about the kinds of things that a CFO would think about at various points in time, or a founding team, follow-on financings, thinking about things like governance, how do you, founders like, you want to, really, it's like the classic, like, well, I want to become rich and I want to maintain control. And so I think I have much more context for how to do that over time and what to think about. And then, I think I also am able to bring some real world examples of things that I've seen around the frameworks that we use when we teach the classes at Booth. So, I think certainly some of my academic knowledge and, I meet great students, here and there, what's really happened for me at Booth is, because I've been involved in some of these pretty, few interesting companies that have gotten to be much larger, here and there when students have been graduating, I've been able to introduce them to some companies that I'm involved in. I probably have 3 or 4 of those a year at this point, where like some students are graduating or they've graduated, and then I'm like, oh, like your background would be really good for this specific company. So we have one company I'm involved in that's recently came out of stealth mode called Farax, and it's a new futures exchange. The chief of staff was a student that I met at Booth, chief of staff for the CEO, and the VP finance, Tony Grief. Tom Rafferty is the chief of staff, and Tony Grief is now the CFO who recently graduated Booth. I introduced him as he was graduating. So I've done a bunch of those things at ShipBob and elsewhere, and so I think that's the way that there's been a little bit of an overlap.
I feel like we are convincing so many people to go to Booth and take your class right now, just for all the potential down the road incentives there might be. Hopefully, to land at a job at one of the fastest growing startups in Hyde Park's portfolio. I'm curious about: do you see other academics, moving into VC? Is this something that you've seen, at least from the business school level? Do you hear of this happening often?
I don't know. I think for me, it was a little bit more happenstance, to be honest with you, Matt. My grand world plan, which I didn't mention earlier, was to go work at the International Monetary Fund or the World Bank. Like that was kind of my grand plan out of undergrad. Part of the reason I went to get a PhD. And so, I think most academics are driven by like curiosity, knowing more about the world. I think VC is just, there's different things that drive people who are VCs, but here and there, occasionally you see people in the academic world going off to start companies, particularly if they're in computer science or elsewhere. So, here and there you'll see people getting PhDs, and especially, in the Bay Area, elsewhere, like come out of school in biotech and they start a company. I don't know that I'm creating a path for folks who, go to get a PhD so you can become a VC. That's not generally what I tell my students. So.
The Professor Weiss movement. I could see it. I don't know. I could see a bunch of PhDs following your footsteps. I'd love to focus on Hyde Park's origin. We had Guy Turner on the show, and he gave us a good lay of the land, I think, of the investment mandate behind Hyde Park and what you all look for in your investments. But I'd love to hear from your perspective, how the fund sort of originated and how it's grown over the past, almost 10 years.
How did we start? Well, I was doing all the startup investing in New York with a pledge fund. It was called RK Ventures, and it was just a partner and I. And then when I moved, I'm originally from the Chicago area. I moved back here, and it was great. It was pretty, I would say, a little bit early in the tech scene in Chicago. Like when I showed up, Braintree was around, and it came through the New Venture Challenge about, like, I think the year that I showed up, and then like the year after I showed up is when Grubhub went through the New Venture Challenge at the University of Chicago. I love doing the startup investing, and you don't really want to do it on your own for a variety of reasons. It's better to do it in a partnership structure, to have at least one other person. And so when I met Guy, I like to say he was like my star student turned teacher, because I was like, oh, he was amazing, and I just loved working with him. And I was like, I know he went off to work at BCG for a year, but I'm like, hey, we got to raise a fund, because like you got to come work with me. And he's like, well, that's great, but like, how are you going to pay me? I also say that there's certainly an opportunity, because there wasn't as much, and still is not as much, early stage capital in the Chicago area and in the Midwest as there is in the coast or in New York. So, we certainly saw the opportunity, but, I think some of it, to be honest with you, was happenstance. And I think for us at Hyde, on the Hyde Park Venture Partner side, at least, I think that remains true to today. There's some capital at the earliest stages, the pre-seed, the seed in Chicago, throughout the Midwest, but the returns on average have been very, very high. And I think the reason the financial returns have been high is because there's not as much capital as you probably want. And so I think the opportunity remains. So, and as Guy had said on your prior podcast, we do early stage, tech investing primarily in the Midwest. And by the Midwest, we include, what you traditionally think of as the Midwest plus Toronto, Canada. I like to joke, which now will be forever remembered, that we include Toronto as part of the Midwest, but don't tell the Canadians that, because that would be upsetting to them. I don't think I've ever said that when I was being recorded before, but I think hopefully they appreciate it, and I think we've really enjoyed the investments that we've made in the Toronto. It's really, really great market, in some ways similar to Chicago. So.
Yeah, I mean, aside from Toronto, were there times over the past 10 years where you two felt pressure to move outside of the mid-continent and maybe take on more geographies? Or have you just been even further emboldened by all of sort of the success you've had in the Midwest, and you've really decided to double down? I'm just curious if there was any ever times where you thought about moving to different parts of the country for your investments.
I mean, I think every firm in VC has to play to their advantages, and I think being close to companies and geographically close is an advantage. And so it's really hard to say take some of the coast. I'm not going to find the best, even if I happen to think I'm a halfway decent investor. Really, really hard for me to get into the really best opportunities in the Bay Area or New York or Boston or even Austin. I think you need to really develop. If you're physically in a market, you have an advantage, or occasionally, if you've made some investments in a region already, you may have an advantage. And so I think there definitely has been internal discussion at our firm about expanding beyond the geographies. We had someone on our team moved to Austin, Texas for a while, and so we had a brief discussion about that. But if anything, I think we've generally been reined in of we want to be investing where we have an advantage. Now in a COVID world, where a lot of things are virtual, some of that advantage has gone away, to be honest with you, where you have coastal VCs, people in the Bay Area just sitting in their background doing Zoom all day. And so we definitely see more coastal funds investing earlier than they did before. But I think still being close to entrepreneurs gives us a little bit more of an advantage. So, the other thing that gives us, I think Guy might have talked about this, is, there are some themes that we tend to invest under, and areas where the Midwest has an advantage, or at least not a disadvantage. And so we've made a lot of logistics related investments, as an example. For Kite Ship Bob, two companies that have done really well, a company called RoadSync. We've made some manufacturing tech investments, a company called Fast Radius that just announced a SPAC that's, a $1.4 billion SPAC. We've made some farm tech investments like farm logs, like things where, the Midwest tends to have an advantage, or at least not a disadvantage.
Yeah, that's actually a question that I was curious about in the first place is, Chicago specifically, but I guess the broad Midwest, you hit a few of them, but would you say that, manufacturing logistics are, at this point, clear cut, that's a industry that the Midwest, or at least Chicago, is a leader in. And it's an area where you think dollars are really going to flow and concentrate in this geography.
Yeah, I think it's fair to say that about logistics. I mean, we're not the only part of the country that is great at logistics and has a, kind of deep-seated roots, like, Atlanta would as well, maybe Indianapolis, which is in our geo. And there certainly are some great, logistics related companies that have sprung up in the Bay Area and elsewhere, the Convoys of the world, the Flexports of the world. But I think there are some pretty exciting local companies in logistics and a lot of logistics related DNA, so that even if you see European or Israeli companies that are logistics related, when they open a US office, pretty frequently they're we'll open it in Chicago. So a company called Bring has done that. There's just a lot of local talent that knows it well. I think for a variety of reasons. One is we're in the center of the country, and so we've always been a little bit of a logistics hub. but there's also a little bit of a quirk of history where the trucking brokerage business was really started in Chicago by a guy named Paul Loeb, who started a company called American Backhaulers. And so there's just a lot of DNA that came out of the starting of that company, which was, kind of 30, 40 years ago, around when trucking was deregulated. And then of course, big airlines that are here in Chicago, like United. So.
I switching gears a little bit. Wow, I just had a trucking pun right there, and I'd even set that up. That's wow, that just flew right off the tongue. That's great.
Oh,
Um,
I love that. I love that. Yeah, you're not digging a hole for yourself here. So.
switching gears, a topic we talked a ton about in our class, obviously, is the due diligence process as a VC investor. I'm curious, given your extensive background in accounting, has startup accounting changed in any way in recent years, or as more capital has sort of flowed into the system? One in particular topic me and Guy talked about was CAR. That type of metric being used more and more. Are there other types of changes you've seen in recent years at the earliest of stages?
Um, I mean, it's a very good question. I think, when you talk about some of these metrics, it's really about KPIs, key performance indicators, and in some ways less so about, you know, the accounting function and direct accounting information. So there's certainly been involvement, some evolution of the way that startups end up using key performance indicators. Guy might have talked about how, you know, I think we all talk about annualized recurring revenue, right? And there's different meaning to that, and that's evolved a bit where companies use like committed annualized recurring revenue, or booked. There's some companies that talk about booked recurring revenue, but booked may not be implemented recurring revenue. And so some of these measures could be squishy. I mean, I think they're all important metrics. And I think, the other things that have been around for a while are things like, cost of customer acquisition, lifetime value of a customer. And there have been, I would say, a bunch of advancements, not pure accounting related, but more like, how to look at those metrics, how to think about them over time, even measures of, virality, those kinds of things. So I don't, it's not as much accounting related as it's like, I would say, metrics related.
For you, was it challenging though in the beginning, when you first started making investments in early stage companies, and maybe even, once you joined Hyde Park Angels, once started at Hyde Park Venture Partners, what was the learning curve for you, like personally, when, you have this background again, probably of looking at financial statements, having sort of fully fleshed out financials to go off of? What was that like for you to get, back into the very early stages when there's so much less data? It was a little bit more ambiguous. Well, actually, a lot more ambiguous. How did that develop for you?
Yeah, I mean, I think the craziest thing for me, to be honest with you, is like the way you set valuations in the early stage world is just so devoid of real financial metrics. So like, some of the companies we invest in are, they're pre-launch. Like, how do you value a company that's pre-launch? People would just come up with these values: $3 million, $5 million, $10 million. This company it's not launched. There's nothing. Like, if you came to me with an idea, Matt, or let's say I came to you with an idea, and I was like, hey, Matt, I've got this great idea. Like, I want you to buy the idea from me. Like, do you think you'd ever pay like 10 million, $5 million or $10 million for like an idea I gave you? No. So like the academic world, business school world, the late stage investing world is a world that's about discounted cash flows. It's about, multiples and comparables of public companies. It's about, let's figure out, look at some comparable exits and figure out what this company's likely to be. And then you get all the way to like you kind of work back over time to the really earliest stage, and you're like, where do these even come from? And there are some methods that people have used, but mostly, what it boils down to is generally the idea that, well, VCs have an idea in their mind of what could the exit look like and why, and thinking backwards through time. We talked about this in the VC lab class of like, what's the capital that has to go into the business in order for the exit to look like X? and then working backwards to what the early stage valuation needs to be. And so I would say that would be the trickiest thing. And I would say what makes it even more difficult is that the later an investor typically invests, when they invest early, they may attribute some like fundamental value to the company, but they also attribute option value to be able to invest more in that company. And so here and there, you'll see like, let's say it's a later stage investor invests in a series A or a seed round, and they put a valuation in and you're like, that valuation is crazy. I've never seen, it's a series A, it's $20 million round at an $80 million pre-money valuation, which, frankly has gotten, common enough in the world that we live in right now, where like I could look at that and say, that's crazy, because 5 years ago in the Bay Area, people talked about the standard series A, which was like 8 on 20, right? That was kind of the standard series A years ago. And now maybe the standard series A is like 15 on 50, right? And you see like 20 on 80, which if you asked any VC 5 years ago, they would have thought that's the most insane thing you can imagine. But you've probably read about, outcomes now we've realized are much larger than we thought they would be in the tech world. But also when you get later investors investing earlier, they attribute fundamental value and some option value. And so they're like, oh, like SoftBank's invested in some of our companies. They've got, billions and billions of dollars to invest. And they're like, okay, well, I'm happy to invest, 70, $80 million in ShipBob now. And I'll value it at X. And then like the next round comes like, oh, now I want to put 200 million in. And so, they're like, well, I want to get involved in a company. It's a great company. And so, there could be a lot of squishiness with these valuations. So sorry, it was a very, very long-winded answer, Matt, but hopefully that gives you some sense of the way that I think about metrics in the VC world. So.
No, and I think that valuation step up year after year, almost that compounding step up, is that ubiquitous? Have you seen it in your geographic areas, not just in Silicon Valley? Do you think it really has trickled down to the Midwest, for example, which historically was always viewed as sort of a conservative place? You needed tractions even at the earliest stages to warrant any kind of valuation. But I think, over time, what would be your sort of sense of how have things sort of progressed even in the mid-continent on that front?
Yeah, I mean, valuations have definitely gone up over time everywhere, in the Bay Area, in our markets. I think, every time it seems like there's going to be a step back in that, at least over the last, really decade now. There may be a very brief step back, but it's like the valuations they can take a long time to go down in the private markets, and they're generally just going up in the private markets. So, I don't know. I think mostly, honestly, it's about finding really good companies and finding really good founding teams. And if you're lucky enough to invest in some companies that could be, hundreds of millions of dollars of exit value, in some cases billion plus, I mean, it's not that the valuations don't matter, but like investing at what years ago might have been a $3 million valuation and then became a $5 million valuation at the seed round. And maybe occasionally now it could be 8 to 10 million, as long as you have a few companies that has really big outcomes, it turns out to be okay. I think the real challenge is making that decision and choosing good companies, because, if you end up in great companies, you're going to have fun and you're going to make a lot of money in this profession. And if there aren't a lot of, if you're not in any good companies, it's tough. So.
And we hit on valuations a little bit there, but I'm curious. You guys obviously have a national network, and so I'm sure you talk to VCs. And there's also VCs based in Chicago who invest on the coast, and they're geo agnostic. So I'm curious, from your perspective, what are some of the differences between investing in startups in the Midwest versus investing in startups, on the coast? Generally speaking, do the startups here bootstrap longer? Are there challenges that they may face, being located in Chicago? Just curious about your perspective on that over the past 10 years.
Yeah, I mean, look at, the cost of capital fundamentally is lower in the Bay Area and lower in New York and Boston than it is in Chicago for startups. Like it's just much easier to raise capital in the Bay Area. That said, for companies and founders that are just starting out, unless you're an experienced founder, it's always hard to raise capital. And so, I would say, what if you think about the Midwest, because there's not as many capital sources around, there's still enough. The cost of capital is higher, and we need to think about that at every stage. And then, I think the other thing that I've noticed over time is like it is harder to achieve hyper growth for companies based in the Midwest than probably the Bay Area or New York, because when those companies, we've got these, a bunch of these companies now that are at these like stages where they are hyper growth or should be hyper growth. And what happens in the Bay Area or and elsewhere is like maybe you can plug in very specialized talent at those stages, and you can plug it in very quickly, and you can like switch people out and get demand gen B2B marketing for someone who's done SMB marketing, so on and so forth. Maybe you post a job rec, and maybe you get like 15 people who have done business to business marketing, demand gen marketing, um, for small and medium sized businesses. And in Chicago, you post that rack and it's like two, right? So that's what you have to get creative about. And I think you do see, good founders, good founding teams being able to like repurpose people. And now in a COVID world where a lot more things are virtual, it's a little easier to get people who are not in Chicago to be willing to like work virtually, especially with the tools now. And so I think you put that all together, and I think fundamentally it is a little bit harder to build billion-dollar businesses in the Midwest than it would be in the Bay Area. But I think it's not it. It is very achievable. We see that time and time again now, and so. I'm not sure. I don't have anything else to say about it, but I think that's hopefully a good explanation. So.
No, I think that's so insightful, and I think that echoes something that I think a lot of VCs in the show have said. And another comment, or I guess hypothesis, that I've taken away from these conversations with VCs based in Chicago is that in the Midwest in Chicago, there is sort of a lack of those true pre-revenue, pre-seed funds here in Chicago that will come in at the earliest of stages when it might just be an idea and a deck and an entrepreneur. And on the flip side, there's a little bit of a dearth of post Series B or even Series B funds to take you to that sort of growth equity stage. Would you agree with me on that, or do you think there are funds that are starting to proliferate that might actually fill that need in the future?
Yeah, I mean, I think those are two very different stages. So I'll talk about them each in turn and like talk about pre-revenue companies. I think there are a good group of like, seed, pre-seed funds in the Midwest and particularly in Chicago now, many of which will often invest at the pre-launch stage. So like for our fund that most people would consider like slightly later than seed, we've made at least three of the major investments we made over the last 12 months have been into pre-launch companies. One is a company I mentioned earlier, which is called Fairax, which is a new futures exchange. That company it was in stealth mode for a year and a half. It had to get regulatory approval by the CFTC, and so we invested. Well before launch. It had to go through really three funding rounds before it launched. That's pretty unusual. But recently, another investment we made is a company called Audit Site. It's actually not based in Chicago, but it's based in our geos. They're pre-launch. We invested in a company called Frank, started by Logan Lahive, who's an experienced entrepreneur. I think if you're an experienced entrepreneur, you can get money at the pre-launch stage in Chicago. We also invested in a company called Cove Markets. It was a pre-launch crypto trading tool, and so I think you can get money at that stage in Chicago. But in some ways, like the more experienced you are as the founder, the better. But there are sources now. Chicago early stage growth. M25, us. Chicago Venture, a bunch of different groups that here and there, Network Ventures and others, like we will all sometimes do pre-launch companies. And I think the more active the national markets are in our geos, frankly, the more likely it is like we're going to want to go earlier. So I think there's some of that, but at the same time, like, we could always use more money at the pre-launch stage. Um, I think the Series B and later is a little bit of is a very different category because that seems to be like a historical critique of the Chicago market, where like there isn't a lot of like local Series B and beyond capital. There's a group called Jump Capital, great group that does a lot of investing, Series A, Series B. There's a group called Valor that is, it's based here in Chicago, but has an office in the Bay Area, an office in New York, and is known really well for SpaceX and Tesla and many, many other, great tech companies. But they do more national investing than local investing. But really, when you get to the Series B and beyond, and in some cases even for the Series A, you are in a national market. And so, like, let's say you look at our fund, like, we are not going to be at an advantage. We're going to be at a disadvantage trying to invest in a Series B company, even some, solid Series A companies, because there are national funds that have brand names that have invested in very specific spaces that are always going to have an advantage. And so, why start investing late, even like you raised a fund to do it, like you're probably going to get beat out consistently by coastal funds. And so, and you see that a little bit. I mean, you have a Midwest focused fund like Drive Capital, that, in some ways, I mean, I think over time they haven't needed to do this, but for a while I thought, oh, they had raised pretty large funds for the Midwest. And then we saw them, like, seemingly, at least at the time, seem to be, well, they have to pay way up for anything that looks like it might be the best Midwest company, because they have to figure out how to win it. And so they were like bidding more than coastal funds might bid. Like ex post, I think, maybe it looked like they were bidding more, but actually, like, all the valuations people paid in it seemed like they might have been too low. But I think that's the problem with these later stage rounds, where it is a national market, and who wants to be competing against Sequoia and Lightspeed and and Benchmark and Emergence and Andreessen Horowitz and others. Like, we're not going to win that game. Now, what we can do is here and there provide the feet on the ground and the local support for those companies that some of those funds may be interested in here and there. But it also depends on the entrepreneurs, and a lot of entrepreneurs don't even support, like, what they don't need anything. So,
do you think that's important for a VC such as yourselves, who's focused on a particular part of the country, based in Chicago? Do you think it's important that you guys develop really strong relationships with those Series B and later sort of national funds? Because then the founders that are coming to pitch you and that you're maybe potentially trying to win an allocation in, you have sort of those built-in networks. You can say, we see you 5 years down the line needing to talk to XYZ fund in New York or San Fran, and we can make that introduction. Is that almost table stakes today for VCs based here in Chicago?
yeah, I mean, that what you're describing, Matt, is what I always used to say and think, which is like, and I mean, it's played out a bit for us where we have had a bunch of follow-on capital for some of our better companies. And I do, like, I was just in the Bay Area 2 weeks ago, and that trip, I don't meet with companies out there. I meet with venture funds and particularly VCs to, like, pitch my companies. But I actually think VCs don't really like getting introduced to companies by other VCs anyways. They want to be introduced by other founders, and they want to have a thesis. And so, like, in some ways, like, maybe I thought we were really being helpful. And we are to some extent, because I think it gives people a little extra comfort. But I think it's just such a national market at this point. Companies announce a financing, as soon as it's announced and it's in pitch book, like every Tom, Dick, Harry, Sally, Sue, VC around the country that wants to be looking for a company in the space is going to know about it. And so I don't know, on the margin, it helps. And literally, like, I was out in the Bay Area 2 weeks ago, specifically telling people about, some of our better stories. But I think the best companies that come out of the Midwest, coastal funds find them. I mean, I can give you the stories about our better companies and how, like, I made some intros, some of those turned into term sheets, but, like, for all of those companies, there were other thesis-oriented investors that were national investors that just found the company anyway. So it's a long way of saying, like, I don't know how much help it is anymore. I think the way we can be helpful here and there is like understanding the dynamics of follow-on financing rounds and how to orient yourself for those. Knowing how to talking to our entrepreneurs about getting the right introductions, which may or may not be from us. I think in the current market where financings are happening so quickly for good companies, the importance of a narrative, the importance of certain things. And, I think some of that coaching can be helpful. But I think the connections themselves are a little less useful than they used to be honest with you. So no offense to my coastal brethren. And there are lots of exceptions where, like, there's one of our portfolio companies, that hadn't really been public about what they were doing. Like, there is a specific VC on the coast, may or may not listen to this podcast, who was like, hey, what great company do you have that you're working on now? And I'm like, oh, I got to tell you about this company. And it turned out like he did really like that company and he did engage a lot. And I think, could have been interested in funding it. And so those things do happen, but they're just not as needed as they have been. So.
And for anyone who may or may not follow you on Twitter, apparently you experienced your first ever earthquake on this trip to the Bay Area a few weeks ago. Just real quick, what was that like?
Matt, thank you. So someone's following me on Twitter, Matt. That would be you. I appreciate that. Yeah, I was actually in the office of a venture firm called Foundation Capital with a former student of mine, Joanne Chen, who's an amazing VC. And we're sitting there and she's like, she looks up and I guess the lights are shaking. And she's like, there's an earthquake. And I'm like, oh, a what? And we're in San Francisco. She's like, yeah, look at they're shaking. I look up, I'm like, oh. And then it like goes on for a bit. And then like people in the office were like, well, I guess they have to get out of the building. So people stood up and they're getting ready to get out of the building. And I'm like, is it okay? How big is it? She looks up how big it was. And my gut reaction was like, I hope everyone's okay. I hope it's not that bad. And like, it was kind of cool for me. It's horrible to say, never been through an earthquake. Hopefully no one got hurt. But I'm like, I never happened to be in San Francisco when an earthquake was going on. And so, again, hope no one was hurt, but I was like, kind of cool for me personally. So,
what an experience. No, it's and it always makes for a good podcast story at the end of the day. So, I think, here.
It wasn't scary for me because it didn't get that bad. And I never, I think if I had been through any bad earthquakes in my life, it would have been, honestly, it would have been like post-traumatic stress disorder. So I feel bad, not only for people who I don't think anyone was hurt in this earthquake, but also like people who had been through bad earthquakes. Cause then you're like, hopefully there will be no bad earthquakes, but we never experienced them in the Midwest in a way that's noticeable. So.
We do not. We have our fair share of tornadoes, and now it seems like we have our fair share of unicorns here in the Midwest, and two of which that I need to mention. I'd be remiss if I did not during our time. ShipBob and G2, both companies that you all at Hyde Park have been a part of the journey from the very beginning. So, first off, congratulations, and I'd love to ask, what do you think were the keys? Now looking back, that they've reached unicorn status. What do you think were the keys to those companies' success over the years, or that led to such scale that they've been able to achieve?
Yeah, it's all about the founding team. It's all about their vision. It's all about their focus. So, we got involved in G2. It was called G2 Crowd at the time. The founding team had started a company called Big Machines, which was like a historical Chicago tech success. And they, Big Machines was like enterprise software sold to companies, and they kind of had developed this hatred for Gartner because, they were a small company and they were like, well, our software is better than these big companies, but, Gartner is telling everyone that these big companies' software is better. And so they had developed this like hatred. And so they went to start G2 after they left Big Machines, and they started. It was called G2 Crowd, and the idea was they want the voice of their customer in to be out there for other prospective customers. And so G2 is like reviews, software reviews, and their pitch was, I go to buy a toaster. I could get like 150 reviews on Amazon. I want to go to a restaurant. I look at OpenTable or Talk, one of our companies, or something else. I get like, 200 reviews before I go to a restaurant. But I buy a, $500,000 a year CRM system, and I have to get a report from like an analyst at Gartner who has even used the software before. Like, I want to know companies like mine and what their experience is. And so that was their vision. And I think it felt like, probability low that they could achieve it. But the fact that it was a team that had worked together before, they were very passionate. They had a success under their belt. We were like, oh, we're happy to take that plunge. And so, we got involved in the seed round. It was us and one other local venture fund. And, look, we've been so pleased. It did just get unicorn status. And I think we've been very pleased. My colleague and a partner at our fund, Tim Kopp, is on the board of G2. And that is a company that now is it definitely has a national reputation in the VC world because people use it for their due diligence as well. So, so that is G2. The two other companies locally in Chicago that we got involved in at the really early stages that are unicorn or near unicorn status. One is called ShipBob, which is e-commerce fulfillment. And look, you have no idea when you're getting involved, you have no idea if companies are going to be unicorn status, right? It's like, are they going to be worth $1 billion? But there, I think you had like really, really passionate founders who had worked together before. And I think we did get involved, like by venture standards, it was very early. We led the first institutional round, which we called a Series A, but really was a seed round. But because the company at the time, it's a lot of service. It provides e-commerce fulfillment. The same thing, your Amazon package shows up. What does ShipBob do? Like they, physically wrap and, put in a box. They've got a warehouse. They put it in a box. They send it off to you the same way that Amazon would. And so I think the reason we were able to get involved early there was it was mostly a service and just a little bit of software. And that allowed a group like ours, which was local, to get involved when I think they were actually at a run rate revenue of about 3 million, but it's all like shipping revenue. And not so interesting to coastal VCs who are mostly looking for software companies. And so really, really passionate founders who grew up together actually in India, both moved here. One moved to go to Purdue, one moved here to go to University of Illinois. Had one of them had some experience in logistics, and I think we've been just a really, really great passionate founding team that really has become the leader in the space. And I think they're hoping to be, there's Shopify. There's a company called Stripe, which is payments in e-commerce. There's companies like Affirm. And then I think we're hoping that people think, ShipBob, if you're doing e-commerce fulfillment, and it's on track to be that. So we're hoping for big things. And then we have these are Chicago-based ones. We have another Chicago company called Four Kites, which is kind of effectively unicorn status as well, which provides e-commerce. It's supply chain visibility software, and they've done really, really well. Founder Matt Ellenjickle, who came from the space and had worked at a company called i2 that was bought by JDA Software and was at Oracle. Unfortunately, went to Kellogg instead of Booth. But Matt was really, really, and we got involved Prerevenue, a really, really great founding story, and we just believed in the vision. So.
I think it's 10 unicorns now in 2021 that Chicago has minted. It's been pretty incredible to watch. And I think in our remaining time, I would just love to hear, broadly speaking, zooming out for a bit, do you think there's anything else Chicago can continue to do to improve as a tech ecosystem? What do you want to continue to see over the years that Chicago as an ecosystem can do?
It's a great question. I think my hope is, really I think about like how does Chicago get on the tech map? And it does that frankly through bigger and bigger successes. $5 to $10 billion tech successes like really like the Grubhubs of the world, like the Paylocities of the world. We have a really good crop of next gen companies like that. Companies like, the ones in our portfolio, G2, ShipBob, Four Kites, Avant and Amount that are also in our portfolio. A company called Fast Radius, it's in our portfolio. And then, big local ones like Active Campaigns and Relativity that are like multi-billion-dollar private tech companies, and a bunch of other, M1 Finance and Cameo and some bunch of others. I think, historically, Chicago's had a lot of companies where the founders, I think, for a variety of reasons, sold out when the companies were worth about $1 billion. So you have, a company called CleverSafe that was sold to IBM for 1.4 billion. You have a company called Fieldglass that was sold to SAP for $1 billion. You have a recent one called Tasty Trade that was sold for $1 billion. A lot of founders, it's really mostly their decision. They're like, well, this company, it's great. It's gotten to be as large as I could imagine for. But I think for Chicago to really be on the map, we need, that next level. And I think fortunately you have a newer crop of founders that are aiming, that do seem to be aiming for these larger outcomes. And I think, maybe that's also, they're able to take a little bit more money off the table. And so it's a little easier for them to do that. But we have a bunch of this next group. And I think, the way we could help mostly is just like funding more and more companies at the seed and early stage, because you just, you never know in some ways which companies are going to end up being that billion or multi-billion-dollar company. And so the more capital there, the better. I think really good entrepreneurs, frankly, will figure it out. And so the more we can get in the stable and the easier it is for them to get capital at the early stages, I think the better off we will be. So.
Yeah, no, I think that is it's sort of that hyper scale, hyper growth playbook that Silicon Valley has really nailed over the last 50 years. That, it's easy to argue that Chicago is just in the early innings of hopefully seeing something similar. Professor Weiss, this has been amazing. And last question, would love to hear about any sort of thought leaders that you follow, resources that you try and stay on top of, as you sort of look out at the landscape of all of these sort of the blog posts, the newsletters, the podcast. Would love to hear if you have any favorites.
Great. Well, I mean, I love your podcast, Matt, and so I've been enjoying them, and I think it's great. I do like, not as a thought leader, but I do like the 20-minute VC, Harry Stebbings, just because I get like, I get a flavor of lots of different VCs, and that's what I like really hearing, because everyone kind of mostly gets to the crux of what their shtick is. I didn't really fully get to my shtick here, but everyone's got their shtick. I listen to A16Z podcast because I love those. Kind of feel like it, you learn what the next gen is going to be like. And then, I guess I'm a little bit old fashioned, and I mostly still read the, kind of the historical VC greats like the Fred Wilsons of the world, the Brad Felds of the world, Mark Susters of the world. I love, there's a really, really great crop of up and coming VCs. And I just like reading like theses that people have. And one person that I've learned a lot from, there's a guy named Ajay Agarwal, who's on the board with me at both ShipBob and Four Kites. And, one of the VCs that I've really learned a lot from over time. And so he's written a bunch of stuff that I followed as well. He's not as prolific, but, anyways, it gives you a little bit of a flavor of the stuff that I followed. So.
Beautiful. We'll check that out and add all those to the show notes. Really appreciate you coming on, Professor Weiss. This is fantastic. We're going to have you on again sometime during the school year next year. Maybe a in-person live recording from the classroom, something
There you
something
go.
like that. Yeah, live
Okay.
audience maybe.
Excellent. Well, thank you so much for inviting me on, Matt. Really appreciate it. Love what you're doing with these podcasts in Chicago, and these, video casts in Chicago. I think it's great to get the word out there about what we're doing, and hopefully, hopefully it was useful for some folks. So.
Yep. Amazing. Professor, thank you. Take care.
Okay. Sounds good. Take care, Matt.